Welcome to Simple Investing Secrets. In this video, we'll review the top 10 best stocks to increase your dividend income. So before we start, please like this video and subscribe to our channel for weekly updates. Let's get started. Investors have long debated whether a strong company that pays consistent dividends will also produce the highest capital returns in the long run. Growth investors generally disagree with this viewpoint, while value investors typically do. Companies that increased or started paying dividends have seen the highest returns in comparison to other stocks since 1973, per a study of dividend-paying stocks by Hartford Funds. Additionally, there has been a notable reduction in volatility. Companies that pay dividends typically distribute their profits to shareholders, whereas those that don't reinvest their earnings to fuel company expansion. Stocks in this latter category typically include Alphabet, Microsoft, and Amazon.com Incorporated. Despite the fact that these companies have gained popularity on Wall Street in recent years, the Hartford study asserts that dividends reinvested since 1960 account for 84% of the total return of the S&P 500 index. A brief history of dividend versus growth stocks. The study has provided a breakdown of the performance of dividend players over each decade going back to before the Great War. Companies' dividend payouts contributed significantly to their total returns in the 1940s, 1950s, and 1960s. Throughout these decades, the total return on investment was on average around 10%. But as average total returns increased starting in the 1960s, dividends began to play a smaller role. As companies prioritized growth over shareholder returns in the 1990s, dividends were largely marginalized. But when the dot-com bubble burst at the turn of the century, investors stopped putting their money in growth companies and started putting it in safe dividend players. The benchmark index posted negative returns in the first decades of the new millennium. For the study, between 1960 and 2021, the median dividend yield for the market was around 2.90%. The yield peaked in the 1980s and bottomed in the 2000s. After the 2010s, growth stocks once again became popular as the social media and e-commerce age dawned. As inflation climbs and the Fed prepares for a further rise in interest rates, investors in the stock market have once again shifted their focus toward dividend stocks to weather the upcoming storm. Let's review our list of the top 10 best stocks to increase your dividend income. Number 10. The Procter & Gamble Company, ticker, PG. The company's dividend yield is 2.59%. The Procter & Gamble Company markets consumer packaged goods. The company has an impressive dividend history stretching back over 6 decades. Whether it's a convenience store, grocery store, or retail store, Procter & Gamble has its hand everywhere. As a consumer goods conglomerate, Procter & Gamble's portfolio of brands includes many household names: Tide, Bounty, Pampers, Tampax, Head and Shoulders, Gain, Crest, and many others. These payouts have also been growing for the past 65 years. In an industry where the median in this regard is just 6 years, the payouts attest to the earnings strength of the company. In October, Bank of America gave bullish comments on Procter & Gamble despite the company's weak EPS guidance. Bank of America expects strong profit growth for the company in the second and third quarters of fiscal 2023. In April 2022, Barclays analyst Lauren Lieberman maintained an overweight rating on the Procter & Gamble Company stock and raised the price target to $176 from $167, setting an extremely high bar for the industry. As of the end of the third quarter, Ray Dalio's hedge fund Bridgewater Associates is the biggest stakeholder in the company with an $835 million stake. Number 9. Johnson & Johnson, ticker, J&J. Dividend yield, 2.58%. Johnson & Johnson makes and sells healthcare products. Johnson & Johnson has consistently increased its dividend for 60 years. It's one of the best dividend kings in the market with long-term growth potential. As a company that has straddled the consumer goods and healthcare sectors for decades now, Johnson & Johnson is unique for now as a powerhouse in both industries. The two sides of the company's business complement each other quite effectively. The consumer health division is responsible for such tried and true medicine cabinet staples as Band-Aids and Tylenol, and these products generate piles of cash on the regular. That income helps support the research and development efforts of the pharmaceutical and medical tech operations. Not to mention acquisitions. In early November, Johnson & Johnson announced it was buying Abiomed, a growing and profitable manufacturer of heart pumps, for $16.6 billion. This will bolster its medical technology portfolio, adding strength ahead of the planned spin-off of the consumer health business. After that occurs, shareholders will own stock in both a thriving healthcare company and a solid consumer health business. Both are doing well and should keep doing so, as pharmaceutical revenue is anticipated to increase by an impressive 12% by 2025, reaching more than $60 billion. Consumer health has been a bit of a sore spot lately. That's due to recent product recalls and the legal cloud hanging over the company. A raft of lawsuits is pending over the alleged presence of cancer-causing asbestos in its formerly talcum-based baby powder. That Johnson & Johnson division is doing well, especially in light of the factors causing share price declines. The company's global non-GAAP adjusted sales increased by almost 5% in the third quarter over the same period last year. In the third quarter of 2022, Credit Suisse analyst Matt Miksic kept an outperform rating on Johnson & Johnson stock and raised the price target to $205 from $200, noting that the med supplies and devices business of the firm was delivering better than expected growth. At the end of the third quarter of 2022, 85 hedge funds in the database of Insider Monkey held stakes worth $7.3 billion in Johnson & Johnson. Number 8. BristolMyers Squibb Company, ticker, BMY. The company's dividend yield is 2.8%. BristolMyers Squibb Company develops and sells biopharmaceutical products. It's one of the best blue-chip dividend stocks as the company has upped its dividend consistently for over a decade. Bristol-Myers' top-line growth seems unimpressive right now. During the third quarter, the company's revenue declined by 3% year-over-year to $11.2 billion. Even after accounting for the detrimental impact of currency exchange fluctuations, the drugmaker's top line remained constant when compared to the same time last year. The company owes this negative performance to the loss of exclusivity of several products, especially cancer medicine Revlimid, one of its best-selling drugs. Generic competition is taking a bite out of Revlimid sales, which came in at $2.4 billion for the period, 28% lower than the prior year quarter. Pharmaceutical companies routinely face patent cliffs. Bristol-Myers is no exception. The key for the company is to replace older drugs with newer ones that won't run into generic competition anytime soon and can grow their sales for years. Bristol-Myers is doing just that. The company has a portfolio of more than a handful of newer products, all of which earn the green light in 2019 or later. Bristol-Myers' portfolio of newer medicines reported only $553 million in sales during Q3, up 61% year-over-year. But they will likely keep gaining ground. Bristol-Myers is also an excellent dividend stock, offering a yield of 2.83% and having raised its payouts by 35% in the past 5 years. The company even increased its dividends amid the pandemic. That's just one more reason why this pharma stock can handle any coming recession. And even if one doesn't happen soon, the company's shares are worth holding on to for years. At the end of the third quarter of 2022, 68 hedge funds in the database of Insider Monkey held stakes in the company. Number 7. Iron Mountain Incorporated, ticker, IRM. The company's dividend yield is 4.8%. Iron Mountain Incorporated is a real estate investment trust, also known as a REIT that focuses on storage and information management services. The company owns secured warehouse facilities and data centers, leasing space for the storage of physical and digital assets, things like art, collectibles, documents, and digital data. As of September 2022, Iron Mountain owned almost 1,400 facilities in 59 countries, serving over 225,000 customers. Its services don't stop at just data storage, however. It also offers a full suite of data management services including digital imaging, records management, secure shredding, and digital workflow automation. The stock not only offers an attractive 5.25% dividend yield right now, but the stock is up close to 5% while the broader S&P 500 is down around 17%. Its total revenues increased 15% in its most recent earnings, largely as a result of increased demand for its services. Similar to earnings, it saw an increase of 10% in adjusted funds from operations. For the past 11 years, the company has consistently paid a dividend to shareholders. It also beat market estimates on revenue for the fourth quarter of 2021 by $10 million. The guidance for 2022 was also strong with revenues expected to be around $5.275 billion against estimates of $5 billion. In the third quarter of 2022, Shlomo Rosenbaum of Stifel kept the buy rating on Iron Mountain stock and raised the price target from $52 to $62. He said that mergers and acquisitions had increased flexibility to speed up the rate of revenue growth. Number 6. Arbor Realty Trust Incorporated, ticker, ABR. The REIT's dividend yield is 11.23%. Arbor Realty Trust Incorporated is a New York-based real estate investment trust, also known as a REIT. It distributes at least 90% of taxable income to shareholders. Arbor offers a total nationwide solution for your multifamily finance needs, including Fannie Mae, Freddie Mac, FHA and bridge loans, among many other flexible options. Early in November 2022, the stock jumped after the company raised its quarterly dividend by a penny to 40 cents per share following strong third quarter results. The company's EPS in the quarter came in at 56 cents, crushing the estimates of 36 cents consensus. In mid-February, the firm declared a quarterly dividend of 37 cents per share, an increase of close to 3% from the previous dividend of 36 cents. The two business segments that the firm operates in include structured loan origination and agency loan origination. The shareholder return of the company is one of the best in the real estate market over the past 5 years. In April 2022, Piper Sandler analyst Crispin Love initiated coverage of Arbor Realty Trust Incorporated stock with an overweight rating and a price target of $20, highlighting the diversified revenue model, industry tailwinds in the multifamily bridge space, and an attractive valuation as some of the catalysts for the shares. At the end of the third quarter of 2022, 13 hedge funds in the database of Insider Monkey held stakes worth $99 million in Arbor Realty Trust, the same as in the previous quarter worth $68 million. In addition to Amazon.com, Alphabet, and Microsoft Corporation, Arbor Realty Trust is one of the stocks that hedge funds are buying amid rising market uncertainty. Number 5. BHP Group, ticker, BHP. The company's dividend yield is 11.09%. BHP Group is a diversified metals and mining firm. The company revealed in April 2022 that starting in 2024, it would have access to enough renewable energy to power 3 nickel mine operations in Australia. 2 of these operations receive their power through a wind energy agreement with Italian company Enel Green Power. A contract was signed between the company and electric vehicle manufacturer Tesla last year, under which the latter would receive nickel from Western Australian mining operations. Ephraim Ravi, a Citi analyst, raised the stock of BHP Group from neutral to buy in April 2022. He pointed out that the company's cash flow generation was up significantly, supporting its ability to keep outperforming the market. Number 4. Genco Shipping and Trading Limited, ticker, GNK. The company's dividend yield is 21%. Genco Shipping and Trading Limited transports dry bulk cargoes across oceans. The company increased its quarterly dividend from 15 cents per share to 67 cents per share in March 2022, a nearly 350% increase. The board of directors of the firm has also approved a new dividend policy heading into 2022. Under the policy, the quarterly payouts will be calculated using a new formula that includes dividends from 2021 and estimates for earnings in 2022. In February 2022, Genco Shipping and Trading Limited posted earnings for the fourth quarter of 2021, reporting earnings per share of $1.99, beating estimates by 5 cents. The revenue over the period was $183 million, up 91% year-on-year. Number 3. Vale SA, ticker, VALE. The company's dividend yield is 9.26%. A multinational corporation specializing in mining and metals, Vale SA, formerly known as Companhia Vale do Rio Doce, is one of Brazil's biggest logistics providers. The world's largest producer of nickel and iron ore is Vale. In March 2022, HSBC analyst Jonathan Brand upgraded Vale SA stock to buy from hold and raised the price target to $21.50 from $17.25, noting that the metal prices were on a path to be stronger for longer given supply issues and higher inflation. Number 2. Chimera Investment Corporation, ticker, CIM. The company's dividend yield is 14.22%. Chimera Investment Corporation is an internally managed real estate investment trust or REIT, founded in 2007 and headquartered in New York City. The primary investment focus is on residential mortgage loans, asset securitization, and mortgage-related securities. In early 2022, Barclays analyst Mark DeVries raised the price target on Chimera Investment Corporation stock to $14 from $11 and kept an underweight rating, backing a strong economy and housing market to drive solid fundamentals for the firm. At the end of the third quarter of 2022, 14 hedge funds in the database of Insider Monkey held stakes in the company. Number 1. Two Harbors Investment Corporation, ticker, TWO. The company's dividend yield is 16.95%. Two Harbors Investment Corporation is a real estate investment trust that focuses on residential mortgage-backed securities. The company has a solid dividend history stretching back more than 10 years. The industry median in this regard is just 5 years. In April of 2022, JP Morgan analyst Richard Shane maintained a neutral rating on two Arbor's Investment Corporation stock with a price target of $5, noting that a reduction of central activity and activity in the mortgage-backed security market should accelerate the normalization process for the real estate sector. This concludes our list of the top 10 best stocks to increase your dividend income. Which of these stocks would you like to include in your investment portfolio? Comment below and let us know. For weekly updates on the best stocks to buy and cutting-edge investment strategies, don't forget to like this video and subscribe to our channel. Good luck with your investments and thanks for watching.